Enemy number one, market volatility. Enemy number two is taxes. Enemy number three is inflation. Enemy number four is lost opportunity cost. Whole life insurance and annuities protect against all four of the enemies that we covered today. Hey guys, this is Chris from the Hidden Reserve, and in today's video I'm going to be going over the four enemies of wealth that only guarantees can defeat, and how guarantees can secure your wealth when nothing else can. So we'll just dive right into things. So enemy number one, market volatility. So market downturns can wipe out years or decades of compounding. And I want to expand on that a bit, because you could be entering retirement, let's say you're 65 years old and you're retiring in 2008. Well, all of those years of compounding don't really matter if you're going into retirement and the market's down almost 40%. So it's really, there's something to be aware of, is that you could be investing during the best time ever, and then when you go to retire, you could have a significant downturn, and that could drastically affect what you were planning to do for retirement. Number two here, timing risk. You can't control when downturns hit, especially devastating near retirement. So again, we don't know when downturns are going to happen. We can only plan so much in terms of, okay, I want to retire at this age with this amount of money, but that's all, you know, if you're not using guarantees, it's very hard to extrapolate out that far, especially if you're planning, you know, you're 40 years old and you're planning for the next 25 years. Like, you can have a good estimate, but it's very, very hard to guarantee, okay, I'm going to have this much in retirement. No matter what happens in the market, I'm going to be able to retire the way I want. Number three is emotional risk. Fear and greed cause people to buy high and sell low. It's just very important you don't tie your emotions into the markets, because if you're gonna, you know, if you're gonna sell out when things go bad and you're just gonna get greedy and not take profits, then that's a recipe for disaster. You have to stay disciplined, you have to have a strategy, and do your best to not tie in any of your emotions to it. Just stick to the black and white plan. And then lastly here, guarantees remove speculation, ensuring steady growth regardless of external markets. The whole theme of this presentation is implementing guarantees into your financial portfolio so that there's at least some aspect that you know is going to happen for sure no matter what the markets do. Because we don't know what the stock market's going to do, we don't know what crypto is going to do, real estate, etc. Whatever vehicles you're using mainly for your retirement, we don't know how they're going to perform, and we don't know when they're going to go up or crash. But it's so important to have something that's guaranteed in your portfolio that's going to ensure that you can live the life that you want to live when it's time to retire, typically through whole life insurance and or annuities. Enemy number two is taxes. So taxes eat away at income, growth, and transfers of wealth, such as estate tax, capital gains tax, and income tax. Most strategies aim to reduce taxes but still expose you to future rate increases. So that's one thing that none of us know how it's gonna go, is our taxes gonna be higher or lower in the future. If I was a betting man, I would say taxes are gonna be higher in the future, just based on how much debt this country is, well, here in the United States. So that's one thing none of us know. We can predict all we want, but at the end of the day, we don't know where taxes are going to go. It's a variable, another variable we don't have control over. Number three here, without planning, you may end up paying more in retirement when you have fewer deductions. So again, I'm not a tax specialist or anything like that, but it's so important that you do have a tax strategy in place on the most effective way to distribute funds to yourself during retirement, on the most cost-effective or tax-effective basis. Again, that's not my specialty, but working with a tax planner, a tax strategist there is extremely important. And then lastly, on the guarantees like whole life and certain annuities allow tax-deferred growth and tax-free access / transfer. So to expand on this more, the powerful part about whole life and annuities is that they're both guaranteed products. So you know exactly how much money you're going to have at a certain point based on the amount you're funding because of the built-in guarantees. Might be around 3%, let's say. If you're contributing, I'm just going to make up a number, $50,000 a year, or scratch that. Let's just say for the whole life you're contributing $10,000 a year, and you want to know for 20 years, and you want to know exactly how much you have at that point in time. You can get that number. You can get the guaranteed number if you're going off the the guaranteed rate that the insurance carrier is giving you on that product. You'll know exactly how much money you'll have in 20 years based on funding $10,000 a year. And the same thing goes for annuities. If you put a lump sum or you roll over a lump sum of $250,000 into an annuity, and you know you're going to have a payout factor of 5%, you know exactly what that's going to be when it's time to retire. So there's no guessing when there's guarantees. It's a for sure, this peace of mind, like, okay, I put in this and I'm going to get this. There's nothing that changes there. So that's really important. And then when it comes to tax deferred growth, whole life insurance and annuities both grow on a tax deferred basis. And then tax-free access, that only applies to whole life insurance if it's set up properly. If it's set up to not be a mech, then you can access your cash value by taking a loan against it. And obviously, since it's a loan, it's debt, there's no taxes on that. And then for the tax-free transfer, with like a whole life insurance, you're going to have a death benefit that's transferred to your beneficiaries income tax free. So that's really important to know on the whole life side. Next up, enemy number 3 is inflation. So inflation silently erodes purchasing power year after year. So that's the one silent tax that all of us deal with is inflation. There's lots of, like, I don't know what the inflation rate is. There's lots of different numbers I see out there, but all we all know is that inflation is real, and every single year our dollars are worth less and less. And even good investment returns can be offset when inflation is high. So you might get a 10% return in the market, 20% return, but if there's hyperinflation or if inflation is really high, that might significantly eat into what you thought you had based on, purchasing power going down. So that's really important just to be aware of if you're not already. And then lastly, guaranteed products provide predictable growth, often keeping pace with inflation and often outpacing inflation over time. So again, with guaranteed products, you're not going to get a crazy rate of return. You might get 3, 4, 5%, but that's, typically going to keep up with inflation at least. So it's really, again, it's a hedge against inflation, a guaranteed product, and it's also, that peace of mind knowing that you can predict or extrapolate out in the future exactly how much money you're going to have based on the amount of money you're funding in. And then lastly, enemy number 4 is lost opportunity cost. So every single dollar you give up, whether that's interest to banks. So if you get like a car loan, for example, through a bank, there's interest on that, obviously, that you're giving up to the bank. They're collecting that interest. You're not. Or cash spent outright. So I have another video breaking this down, but if I were to pay $30,000 cash for a car, yes, I own the car and I have no debt on it. But the other thing is that $30,000 is no longer earning it. I don't have the ability to earn interest on that money ever again because I use it to purchase the car, opposed to other strategies that on this channel we talk about, like the infinite banking concept, is you could first put that $30,000 into a high cash value whole life insurance policy, specifically designed and engineered for infinite banking, put the 30 grand in there, take a loan against the cash value to purchase the car in cash. Meanwhile, while you do that, you still have your original $30,000 inside of your policy, earning that guaranteed rate of return. And then if you're with a mutual carrier, which we always suggest for this concept, you'll get dividends paid out on top of that. So now you have your money always working for you in the policy, and you were able to acquire that car through the insurance carrier's money, because in this case, you're getting a loan from the insurance carrier when you borrow against your cash value, and then you use that money to purchase the car back, and then you pay back that loan on your repayment schedule. So however you want to pay that back, because there's going to be interest on that loan, but you can decide how you want to pay it back in terms of scheduling. So you could say like, okay, I want to pay this back over the next 60 months at this monthly rate. You're not locked in. When I say rate, like dollar amount, because there is a locked in interest rate that you're going to be paying on the loan. But when I say rate, it's more like repayment amount, because you can decide on top of the interest that's due, you can decide how much you want to repay back for that loan. So that's just really important to keep in mind. And then next up, most families lose hundreds of thousands of dollars over a lifetime this way. So when you really add up all of the major purchases you're making in life through bank financing or paying things in cash, that's going to add up for the average person to be hundreds of thousands of dollars that they no longer have the opportunity to earn interest on. It's that money has left their hands forever. And then lastly, guaranteed systems like infinite banking lets your money grow while you're using it. So again, to recap that, if you have money inside of your policy, then you're going to be earning a guaranteed rate of return. And then if you're with a mutual carrier, you're going to get dividends on top of that. And if you want to make a major purchase or an investment, for example, instead of just paying cash or getting outside financing, you can self-finance by borrowing against your cash value, getting a loan from the insurance carrier, and then using the insurance carrier's money to purchase the car or to make the investment. Meanwhile, while you're doing that, you're going to have your original money in your policy earning that guaranteed rate and the dividend if you're with the mutual carrier all at the same time. So you're making money in two spots ideally. Well, not on a major purchase, but if you're going to be earning money inside your policy no matter what, but if you're using the loan to do an investment, that's where you have the potential, if you made a good investment, to earn money in two places at the same time. Internally with the policy, and then externally with whatever other investment you made. So the solution to combat all four enemies that we covered in this episode today was obviously guarantees. Whole life insurance and annuities protect against all four of the enemies that we covered today. Whole life, you get tax deferred growth and guaranteed compounding, which equals long-term certainty. So again, you're with whole life insurance, if it's set up properly, there's no tax-free growth. It's going to earn and grow tax deferred, like a 401k, for example. And then the way you access the money tax-free, just like any borrowing against anything, but you have to borrow against the policy's cash value, and then you'll get a loan from the insurance carrier. And then the guaranteed compounding is based on the contractual guarantees that you have with the policy. So you'll have usually like a 3% guarantee, and then you'll get the dividend, which is not guaranteed, on top of that. And something I want to just point out is that the carriers we work with minimum have been paying dividends consecutively every single year for over 100 years. So yes, the dividend's not guaranteed, but I mean, it has such a strong track record of paying dividends if you're with a top mutual carrier that's been around forever. So just keep that in mind as well. And then for another thing on whole life is the cash value provides both growth and access without giving up control. So the growth is obviously, we've covered that, the guarantees that you get and the dividends, and then access without giving up control is you can request a loan against your cash value pretty much any time that you want. So you don't have to go through a credit check. You don't have to go through any hoops to actually access your money in there. As long as you have the available cash value, you're able to get a loan, no questions asked, from the life insurance carrier. Unlike a bank, that's not necessarily the case. You have to do a credit check, proof of income, etc., to even see if you qualify for the loan. With this, it's you contractually have the right to access those funds without going through all these hoops, as long as you have enough cash value to do so. For annuities, it guarantees you never run out of retirement income. So something so powerful about annuities is not only knowing exactly how much money is going to be paid out to you. If you quote unquote run out or exceed the amount of money that you put into an annuity, like if you put in a $200,000 lump sum into an annuity, and let's say it grew to $300,000 and you're taking income from that, even if you distribute more than $300,000 of it, or if you distribute up to that $300,000 that it accumulated to, And let's say, in your mind, you're like, okay, well, I had 300,000, I just completely depleted my account. Yes, that's the case, but you're still going to get paid an income stream beyond what the account value grew to with an annuity. So you're guaranteed to never run out of money with an annuity. And that's how most pensions are set up. It's using annuities because they're guaranteed products that will last the rest of your life. And then lastly here is real financial strength comes from having guarantees in your financial portfolio. So if you ask anyone who's in retirement that has a portion of their portfolio that's guaranteed, especially for retirement income, it just gives you so much more peace of mind. Because imagine you're in retirement and the bulk of your investment, what you're relying on for retirement, is in investments like the stock market, and the stock market plummets. Now you're freaking out because it's like, well, when is it going to retire or recover? Am I going to have enough funds to still retire the way I want? There's no certainty there. But if you went into retirement knowing that the guaranteed aspect of your portfolio is going to cover your living expenses and your retirement lifestyle, how much more peace of mind would that give you? Knowing no matter what happens in the world, as long as these life insurance carriers or wherever you have your policies, as long as those carriers are in business, you are guaranteed to get a benefit that's going to meet, based on how you designed it, is going to meet your retirement goals. So no matter what happens in the world, Armageddon, the world goes up in the flames, as long as that carrier is still around and they're profitable and performing, and if you go with a carrier that's been around forever, that will be the case, then that just gives you a whole new level of peace of mind. It's like, okay, I've got an annuity that's paying me $5,000 a month. That's enough to cover my living expenses. Like that, it's just, you can't compare the two. So my opinion, just having something in your financial portfolio that guarantees, whether it's retirement income or even a death benefit for legacy, which we didn't really cover in here, it just gives you peace of mind because it's going to do what it's going to say it's going to do based on the contract and how you set it up. And then lastly here, I want to add in the biblical tie-in to all of this. So in Proverbs 27:12, it says, "The prudent see danger and take refuge, but the simple keep going and pay the penalty." So what I derive from this is that guarantees will shield your money from uncertainty, like we just covered throughout this whole presentation. And then God's design is for stewardship, not gambling with what we've been entrusted. So when I put that there, I'm not saying I'm anti-investing at all, because I'm not, and it'd be foolish to not invest your money. But I just strongly believe that a portion of your money needs to go towards the safe bet, where it's like, okay, I know I put money here and it's going to guarantee an outcome for me in the future without any risk, virtually without any risk. And that's why I just think that's so important, because if you have all of your money in the markets and you go to retire, if the markets take a huge dump, then it all could have been prevented by planning accordingly with guarantees involved. So that's my opinion. I just think it's so important that a portion of our money, especially as stewards, we're guaranteeing that it's going to produce a result in the future. So conclusion of all of this here today: market volatility, taxes, inflation, and lost opportunity cost is unavoidable. But you can shield your wealth permanently through guarantees. And guarantees provide freedom, clarity, and lasting security. It's going to do what it says it's going to do. So next step, I really hope this presentation, you got some value from it. Just seeing the importance of guarantees within a financial portfolio. If you want to learn more about this and see how guaranteed products might be able to help you in your future, help your family in your retirement, book a discovery call with me. There's a couple ways you can go about that. I'll have a link in the description where you can go to my calendar, just pick a day and time there that works for you. If you don't see a day or time that works, just shoot me an email and we'll figure something out there. And if you haven't already, subscribe to the channel. I make videos like this every single week, and I put out 2 short form videos a day as of right now. So subscribe, put the notification bell on to stay updated with all that. And also I want to mention, I just started a blog. So again, every single Wednesday, I'm putting out a blog on my website. Again, that's going to be in the description. If you go to my website, you'll see a section that says blog. And I have a lot of this information around insurance, annuities going out there. So check that out, and then leave a comment as well if you have any questions from today's episode. But again, hope you enjoyed. Thank you for watching, and I'll see you in the next video.